What we're going to be talking about today is, how do I move this slide? There's a button. There. I also talk to myself, apparently. So today is your financial plan. It's the fifth in the Dream to Business Plan series. This webinar is going to focus on the statement of cash flows, and the webinar replays for all the previous ones are on the website, NADF.org/webinars. There. This is me. I've been with NADF since 2013. I have a business diploma from Northern College. I'm born and raised and based in Timmins, and I've been doing something along these lines for a little over 20 years now. I really fell out of it in high school and fell into this career, and I was really good at it at first, and I've only been trying to maintain that feeling of really good at it. I have reviewed and advised on hundreds of cash flow statements, and I've had some of the best training you can get in Canada on how to look at these things. So what we're going to do today is go over the statement of cash flows in 5 parts. So the first 5 parts are going to be revenue, the expenses, taxes, the net cash flow, and notes. And if we have time at the end, we're going to give a brief overview of the income statement and balance sheet. So part 1 is revenues. Now, in the previous slide, we managed to show the entire statement of cash flows in its entirety. So it's quite a large document. Not a large document. I mean, like, it takes the whole page up, so it wouldn't be very conducive to doing it in a PowerPoint. So I've taken out individual chunks. So you can zoom your Excel if you want to do that. But what I've done is I've taken some pictures out so we can focus on each part individually. Now, when we enter numbers into the cash flow statement, remember that there is 12 months of this. Well, I'm only going to show you the first 3. So the revenues at the top, they are entered as monthly totals. They are entered as categories, and you can change the name to suit your business. You don't have to change your name. You don't have to change the categories, but it helps you communicate with me. And that's really the point of a cash flow statement, is to communicate with whoever you're going to be asking for funding from, what exactly you need. So the more information or the more tailoring you make this for you, the better you'll be able to communicate with me that. So once we change the names to suit the business, we can figure out what the dollar values are, and we're going to talk about how you get those. So let's rename the categories to, actually I can. I can send a PowerPoint, but I'm not going to pause this to do that at the moment. My suggestion would be to open up a Word document or just keep notes on the side. So I'm going to, let's do this as a pretend for Bob's Burger Bus. So Bob's Burger Bus sells poutines and fries, burgers, drinks, and a delivery charge. So if you've ever been to a chip stand, you'll know that they don't just sell poutines, burgers, and drinks. They sell a wide variety of things. So what we've done is we've just jammed them all into categories. So we basically saying poutines and fries, all the different poutines, all the different fries, all the different burgers in one section, all the different drinks, and a delivery fee, because they're slightly different. When you're communicating in this way, you want to have when you're communicating in this way, you want to have broad enough categories to kind of capture what you're talking about, but specific enough so that you're not, there's not so many categories. So I could have also added like miscellaneous. That's where your jalapeno poppers would be, and your mozzarella sticks would be in miscellaneous, but I've chosen to include them in burgers. Poutines and fries could also include like a salad. I'm not sure who goes to a chip stand for salad, but if you were to sell salads at your chip stand, they would put it there. That mode of thinking is excellent when you're trying to do any type of business. So it could be a gas station, could be a retail store, could be a rocket ship building facility. All of those things together can be boiled down to a handful of different revenue items. Remember, this is just for communicating with me. It's not for, it's not an audited financial statement. So where do these numbers come from? Your assumption of research is simple. During the business plan portion, you're going to do lots of research, market research. You're going to go interview people. You're going to do a survey. You're going to go online. You're going to find stuff out. So let's say that this cash flow is based on an entire business plan. And in that business plan, we're going to have a research section. So Bob's Burger Bus market research suggests that on average, on a typical day, you're going to get between 25 and 50 customers a day. Most of those customers will purchase a poutine. Many will purchase a burger. Almost all will purchase a drink, and few will call and order delivery. So we quantified those numbers, most, many, almost all, and few, put some percentages beside them and did some calculations. Now I did a conservative look. So let's say the minimum of 25 customers a day. This is part of that mind of thinking where 25 customers, that's people. So that's minimum of people. So let's say a couple shows up, well, that's 2 customers as opposed to 1 order. So let's show what the calculations for that is. So let's say we've seen 20 poutines sold, because we're talking about most of the 25 customers will order poutines. So that's 20 poutines, 18 burgers, 23 drinks sold, 4 delivered orders. We're literally taking what we think is the minimum amount of people who will come to our store today and applying what we figure is our best guess of what they'll buy. So we have an idea, a quota, a forecast, 20 poutines today. Now that helps me go in the back and peel potatoes for 20 poutines because I know how much that is. But that's not part of the cash flow. We're not worrying about how much potatoes I need to peel for the poutines. We need to know how much revenue we're going to make. So let's take that calculation. So Bob's Burger Bus's competitor research suggests. Now, part of the business plan is when you figure out how many people are coming, you're going to have to figure out your prices. And the best way to figure out prices, especially if you're not a new and unique company, you probably have some competitors. And I could literally go to Google right now and look up the other poutine shacks in Timmins and say, okay, this is about what they charge the poutine prices and burger prices. And since I'm a fan of poutines, I know how much a good poutine costs. This is about $9. We can also get a good burger price of about $6. So that's where these numbers come from. These numbers come from a good estimation based on some market research and based on looking at the competitor analysis in your area to trying to figure out how much you should be charging. And this could be true for almost every business you could possibly dream of. There will be people who are operating in the realm that you're operating in. And when you're operating in the realm, you may be able to get a good idea of what these prices would be. So that's where this comes from. And this will be outlined in the business plan. So we're, again, looking at a cash flow, taking information from the business plan. The calculations for that, well, you'll see 20 poutines, you look at $179.80, $107.82, $45.77, $16. This is, again, we've step by step. How many people are coming? What's the percentage that they're going to use each one of these? What's going on with this? Now we have a good idea of how much each segment is going to make. So let's translate that. But first, we're going to clean it up because we're doing a forecast. We're not doing an audited financial statement. We're doing something we hope to happen. Let's not fuss about 79 cents. Let's round everything to a nice whole number. 180, 110, 45, and 16. That is going to be our day. So now that we've got to round it, we're going to multiply each category by 30. Now you're asking, okay, well, there's only 28 days in February. Again, we need to create a good guesstimate, a good estimate of where we need to be. So it's fine to apply a standard rate across the entire year. We are trying to get our best guess based on the information we have. We're not clairvoyant. So we multiplied each by 30, and then we've entered them into our cash flow the first 3 months. You see that? So as an Excel, it automatically adds up. But if you're doing this by hand and you haven't seen it added up, you can put it in yourself. But you'll see $10,530 is what we figure, or what I figure, the monthly income revenue, raw cash, for a business that would sell chips on the side of the road. So do that. And then we've put in June, July, and August. So this is what we've done now. We have completed revenues based on the information from the business plan. We have cleaned it up a little bit, and then we have flattened the curves. So revenue is now complete, and we can fill it the rest of the month. So that June, July, August, just go right across the entire way. And you're going to find at the end of the day, we got $136,000 as revenue for the company over a 13-month period. Now, we can increase and decrease this because it's not set in stone. We can increase, let's say, July weekend or July. Chip stand is going to make a lot of money in July, but not quite so much in December. So we can increase some months and decrease other months. That creates spikes, but that's okay. If you want to do that, and that's absolutely fine to do that. But if you don't, we can kind of use a smooth level and make sure that everyone's operating around the same. It does mean that when it actually happens, you'll see a spike in July in your actual reports. Again, this is just an estimate. So for this exercise, let's assume that all months are equal. And we can move on to expenses. We'll take a break for a quick second while we just absorb what happened with revenues. And if there's any questions in the chat, I don't see any. I think we're good. I know there's a few second delay between when I ask for questions and questions may appear. So for part 2, it's the expenses. Now this is not as complicated as revenues. It's a little different, but it should be okay. So below the expenses are revenue. Below the revenues are expenses, and they are entered monthly, just like revenues. They are entered as categories, just like revenues, and you change the name to suit your business, just like revenues. And we're going to figure out the dollar values. So looking at these, do they make sense for a burger bus? And I see a lot of things that make sense. I see hydro, phone, wages, fuel, accounting, bank fees, insurance, tax, internet, rent, loan fees, etc. But what I don't see in here is the cost of goods sold, or COGS for short, because we are selling something. That something has to come from somewhere, and that somewhere costs money. So in the example of poutines, we got to figure out how much potatoes are worth and how much we're going to spend on potatoes and cheese. Just as a side note, believe it or not, if you were to do the books for a poutine company, you will find that the gravy is the most expensive piece of poutine. So let's take a look at that. So what I did was I took my Excel, I inserted a line called the cost of goods sold. I also took a line out from the bottom. Now that's kind of what I want to see here is a little bit of modification, because this is important for a poutine. The rest of it, we can shoehorn the expenses into a lot of these categories. They don't need too much modification. So I've added cost of goods sold. It's important. We're going to talk more about that later. It's one of the reasons why I picked a restaurant or a place that would have a cost of goods sold, as opposed to like a service-based business that wouldn't have this. So we're going to assume from the research, most of the expenses are self-explanatory and can be easily located in research. For example, if you want to know what the average hydro costs for that location you're going to, you can call hydro and you can say, hey, how much was last year's hydro at that location? They'll give you how much it was, because they do that to be able to help budget out. Same as the insurance. So you can call your insurance company, you get a quote, you divide that by 12, there's your monthly number. The rent is self-explanatory. You can call the potential landlord, get a number, enter it in. Phone and internet, again, these are just things, they're just steps. Work through the list, find what needs to be done, and then keep marching forward on that. Bookkeeping, bank fees, interest, loan payments, everything can be done in every line. You just got to remember who to call. So your loan payments, if you are applying with me as part of this process, you can call me up and say, Cory, what would be my monthly payment on a $25,000 loan? And I can give that number to you as a ballpark. No one can give you the firm number until everything happens, but you can get a really good estimate. And you can put in there, I spoke to Cory and he says the loan payment would be around $300 a month, or $250 or $200, depending on what you want to do. So these are all assumptions from research that you have already done as part of your business plan, because you're just gathering all this information and building your cash flow based on a lot of what you've already done. So I filled in a bunch of the things that are really easy to find out. And you'll see I've got hydro, phone, fuel, accounting, bank fees, interest, loan payments. Some expenses occur quarterly and are entered every third month. So an example of that is accounting. You can hire your bookkeeper, you pay a fee to do your quarterly remittance, and she'll charge you some money for that. She may not be charging you monthly. She may charge you quarterly, or you can do it annually. So it depends on exactly what you want to do. Again, these things are not done in stone. You can take one out, put one in, wherever you need to be. So there are also budgets. So let's take a look at the advertising and marketing budget. You may not spend $200 per month, but you may spend $400 in 1 month and skip a month. Or you may just have that potential to be able to spend that, but it's calculated in. It gives you an idea of how much money and where that money is going. And let's take a look at stationery and printing. At the very first month, you are very likely going to buy a whole bunch of menus and get your signage done. That will take a good chunk of cash upfront. That's an upfront startup cost. You're not going to do that every month. You're not going to be buying all these things every month. So it's good to have it at the very beginning. And if you anticipate doing it again, go ahead. Now, I put that number in quarterly. Can't see that here because we're only looking at 1 quarter, but it'll expand in a minute. So another one. We missed 2 back there. I'm going to flip back, watch. So we missed 2 there. The cost of goods sold and wages, they're blank. Okay, and that's for a reason. We're going to talk about it right here. So to figure out your cost of goods sold, there are resources online. So what I did was I went and looked up, I typed a chip stand North American industry classification system, and it gave me a number, and I used that number to find out the industry average. That's a little bit of an advanced step. What you could do is, if you are generally making a business that you are aware of, you probably have an idea of how much it costs to do that, how much the cost of goods sold are for those. And that's great, especially if you have that information. If you don't, you may be able to speak to other people who have that information or have more experience than that. But generally, in my experience, if someone is coming to me with a business plan or a business idea, they have some experience in that. And that experience will let them fill in that cost of goods sold. Now, I've never run a chip stand before, so I know how to find out the industry averages. And the industry average on that is 47% of cost of the anticipated revenues. But for the purpose of this, I'm going to use a nice flat number, $2,500 a month. So that's going to be the cost of your chips, your French fries, your burger meat, everything else like that you sell. So we're going to use that flat rate in there. Because the revenues is flat, we'll use a flat cost of goods sold. The other large expense is your wage. So you want to open up a business. At the end of the day, you need to pull money out for yourself, for you to pay for your own needs, because you won't be able to have a full-time job if you're doing this full-time. And we kind of require you, if you want to have a business, to be able to operate the business. So that's an important number to go in there. You have to think about it yourself and say, how much money do I need to survive? Let's use $3,000. So we've put those in there, $2,500 in the cost of goods sold and $3,000 in wages. So the wages is your wage. It also includes other people, but it should be enough to sustain you. And this is part where you put in your own personal budget and say, okay, what are my minimum costs to be able to live? If you were doing this and looking at this cash flow and realize that you need to put $8,000 or $9,000 into wages, you are suddenly going to have to realize that this business may not sustain you and there needs to be changes. So it's a wonderful exercise that needs to happen. Now, I need to put that reminder in. A couple of times we're in there, this is an exercise. It's market research and industry analysis will provide much more accurate numbers as part of your business plan. I don't have a business plan when generating this. I'm generating it based on my personal experience with a lot of these types of businesses, and it's just for demonstration purposes only. So our expenses are there. The assumptions from research created the expense portion to marry to the revenue portion. So the expenses are now complete. Fill out the rest of the months, and if an expense will not occur or change depending on the season, make the adjustment. For example, it's reasonable to add snow removal in the winter, but not in the summer. And you could add that to, for example, your rent. Your rent may go up in December, January, and February by $100 or $2. And if you know that, put it in. Don't be shy. The best way to communicate is to put all the information on the table. All right, part 3, taxes. If we remember at the very big thing, there's a line for taxes and the expenses, and there's a few spots and other spots for taxes, and it's always a consideration. Taxes is and will be an entire semester of learning. It's not something that we could bang out in five seconds or 2 or 3 slides. But what we can do is ask some very important questions. What type of business? Are you on or off a First Nation? Are you incorporated or not? And is there any special considerations? So there's a few answers to this. So what type of business? You need to have special considerations. What type of business will help you determine what additional taxes or issues you may face? So a fuel retailer has additional taxes. I believe it's a federal excise tax. First Nations people don't always don't have to pay that tax, but the business owner has to pay it in advance and apply for a rebate. So that's a consideration you need to worry about. If you're on or off a First Nation, HST, RST, must be charged to any non-status individual. So even though you are on a reserve and you're operating a store and you're there and you're selling 90% of the time to First Nations people in your First Nation, if a non-First Nations member shows up, you have to charge them HST. You have to report that. Are you incorporated or not? There is no way a corporation can be given an Indian status card. It's just not going to happen. So corporations are always going to be paying some sort of corporation tax. That's where I'm going to refer you to a qualified professional to get better advice on exactly what you need to do. And this little webinar is not going to cover that. Any special considerations, like how are management fees handled? How are dividends fees handled? How is your personal income tax handled as you come out of your as you pay yourself as a sole proprietor? Again, those are longer, more complicated answers and not part of the cash flow, because we just want to kind of keep it simple. During the funding process, we can set up those contacts and say, these questions are really easy and straightforward for professionals. All you need to do is sit down and they will explain it to you. Much like I can explain a cash flow to you in 45 minutes, a tax professional can lay everything out for you in a half hour or so. So don't stress about it, but we're not going to talk about them in the cash flow, and we're not going to put them in the cash flow. Oh, there it is. So HST, harmonized sales tax, GST, goods and services tax, RST is the retail sales tax. RST is Ontario. It's kind of phased out, but it does appear in certain things. So again, we spoke about this, or I spoke about this just a minute ago. When you're selling goods on a reserve or off a reserve, if you're on, you have to be careful of who you're charging your HST to. Everybody should be giving you a status card to be able to be exempt for that, and if not, you still have to charge. When you are pulling money out of your business and you are on a reserve, you will very unlikely pay income tax on that. Again, someone will be able to lay that out for you as a tax professional. And I looked it up, and there is a comprehensive list of what is charged and what is not charged HST. So these are the parts where you would have to be aware of, but we don't need to see them on the cash flow. There is a line for it, and if you want to put some stuff in there because you've done the research, go ahead, but it's not going to be detrimental to your project. Now, income tax, there is a line. See, I highlighted it in yellow. We'll speak on this specifically. So let's say you did open up a corporation. And the reason I'm not putting this in the cash flow is that when you file your income tax at the end of the year as a corporation, if you make less than $500,000, you will be charged 3.2% in income tax, corporate income tax. Now, this company that we're looking at here has a net revenue somewhere around 136, with a net income well below that, somewhere around 20K. So if we do the calculations, and I did on the side, it's about $25 a month. And when we're talking about a cash flow of this magnitude, we're not even worried about $25. We have to acknowledge that income tax is a thing, but again, we're not really going to worry about it too much for this size and scope of a business. If you are looking at creating a business with net revenues, $500,000 or more per year, then you are in a much better position to be hiring a team of accountants and or consultants. And this is probably or likely a multi-million-dollar project. It's not a problem, it's a project. So that's why we have to have the tax conversation, but for the size and the scope, it is very unlikely to be a problem or an issue while we review your file. So there, we have completed the table for the most part. Revenues on top, expenses on the bottom, and a net cash flow. If the Excel doesn't populate for you, you can just add them up. Total cash, total paid out, top minus the bottom gives you a difference of 1455. You see that? Based on these estimates, the cash flow is positive. So based on what our market research has done, based on what our expense research has done, we are at a positive cash flow, which is good. You show me that, I'll give you a thumbs up, and we'll have much more conversations. If you've done this as an exercise and you get a negative number there, we need to have a conversation about where your research was. Is your project actually viable or not? How bad is that? Where is that extra money going to come from? So those are other conversations. There, the completed cash flow. Along the bottom, you're going to see net cash. It's a little small, but you'll see the net cash flow is stable and it slowly adds to the opening bank balance. And that's what this is to demonstrate. It just demonstrates over a year that your income is greater than your expenses that you forecast. We don't know this for sure, but this is based on their research. This is our forecast. So the net cash flow for the most part is complete. There is one final section, part 5, which is the notes. So let's say you've done this exercise, you printed out that out, you have a whole bunch of numbers on there, you fire it off to me and I take a look at it. And I say to myself, how did they get the put in number? Well, the notes is probably the easiest part. It's one of the most important, but it's the easiest part. The notes are an important part of any statement, not just the cash flows, but in this part, this is why. And it's done. So it's done already because to revenues, we had already done the work and the research and put it together to, much like this slide in this PowerPoint. I had already created this slide a long time ago, and I literally copied and pasted it right here. You can do the exact same thing with your notes. At the end of the day, you fire off that cash flow statement to me, and you add that little section that says notes. And this is what it needs to say. Revenues based on 20 customers, 20 customer orders per day at market rates. And if I want to know what market rates is, I can jump back into the business plan and find it because it's there. You could include it. It's up to you. Expenses are based on quotes provided by vendors and industry reports. Again, probably very likely part of the industry evaluation or the market research in the business plan portion. These numbers weren't created out of thin air. You're just pulling them out of the business plan and putting them in a nice cohesive spot for me to look at. And based on the scope and project and location, taxes are not factored into the cash flows. Now, I'm a professional. I look at these all the time. That makes sense to me. Okay, that makes sense. I understand that's why there's no taxes on here. Great. The notes is probably the easiest part, but is probably the most important part because it fills in that blanks. How did you get to that revenue number? How did you get to that cost of goods number? It backs up the validity of the cash flow statement. Now, in retrospect, I was thinking maybe I should have put a thank you slide right after this one, but I'll pause for a moment and we'll talk about any questions that may appear. I don't see any just yet. And time, I feel, is pretty good. So we'll go over a basic conversation on the income statement and balance sheet, just to, I was thinking about singing a song, but I don't think it'd be appropriate. Maybe some background Jeopardy music or something. If you have any questions later, you're more than welcome to drop me a line on my email or give me a call. For the most part, we will look at the sample income statement. So I pulled this. If you go to Google and you type in sample income statement, you're going to get tons of stuff, and a lot of it's advertising. So what happens is I pulled this from the Business Development of Canada, ABC company income statement. You'll see that it's very different than a cash flow, and it's laid out differently, and the income statement represents the entire year and focuses on the income or loss of a company at a time, at the end of a period. So you'll see that there is no breakdown of what expenses are what. You'll see that there is no monthly breakdown. Well, you can create 12 income statements if you'd like, but that's generally not something anyone does. These are usually done to give you a snapshot of how the business has performed over a year. And in this, the net profit earnings after tax, way at the very bottom, does not represent how much cash you'll have at the end of the day, because the cash isn't even on here. You'll notice that there isn't a cash balance statement. There isn't a cash account. And on here, many of these things are revenues that are cash-based. Many of them are expenses that are cash-based, but there's one that isn't. And there are non-cash items that appear on an income statement, such as depreciation, that affect your income statement but don't affect cash. You could have $100 in the bank but show a zero profit because the non-cash items lowered your income, but because they're non-cash items, you still have that cash. So again, that's the different ways of looking at it. That's the major difference between a sample an income statement and a cash flow. is that the cash flow is more of a management tool. It's more of a forecasting tool. It's more of a where are we now and where are we going to be in the short term? And income statement is at the end. It's like, whew, how did we do? That's your income statement. The income statement feeds right into the balance sheet as part of your financial statements package. So the balance sheet shows what the company owns as an assets: cars, trucks, automobiles, planes, and owes: bank statements, credit cards, etc. With the difference being what the company is worth. So when we do a grant and a loan, for example, there's equity, there's a loan for a vehicle. Your equity and the loan together buy the vehicle. So now you have a plus on your balance sheet, on your asset side of a vehicle, and a minus on your liability side because you owe money on that vehicle. And that creates the balance. So you have a plus from a vehicle, and then the liabilities come up to match it. But in this case, when we provide something with equity, the loan does not match the assets. So the loan may be a little less. So when you have a little less, you're a little out of balance now. So you need something to fill this little gap here. And that's your equity. That's what the worth is. Assets always have to equal what you owe plus what owe, and then the equity in your business. So the balance sheet is always going to balance, but this hand is going to be everything you owe plus whatever you've invested, your money and the bank's money to buy the vehicle. And this is always done at a snapshot in time. And to point in fact, the cash balance here, $5. Now, the cash balance is $5 on March 31st. And that March 31st would have already happened. And again, much like the income statement, at the end of the day, we take a look and we stop and we say, what happened? How did we do? And when we say, how did we do? We make an income statement, we marry that to the balance sheet, and then we can compare it to how we want it to do. But the cash flow statement is always going to be, how do we want to do? So how do we want to do something versus how we did? And that's where these income statements, balance sheets, and cash flows all create that knowledge base that you can make decisions going forward. And that's it. It has been a little over 40 minutes. And my name is Cory Robin. I'm the Business Development Officer here at NADF. I'm in Timon's office. And I'll be live here for another minute or so for any questions. Otherwise, thank you very much for coming.